Welcome to our latest episode of Capital Markets Cocktails. Today we have a great guest and an incredibly timely and engaging topic to discuss. I'm Tyler Durr, a senior manager here at Lambert, and I'm joined today, as always, by my co-host, Jeff TiiCKER, senior director. And now let's introduce our guest, Jeff Lambert, founder and CEO of Lambert, and founder and CEO of TiiCKER, a Lambert company. Jeff, you able to provide a little background for the people here?
Sure, and I'm really excited to be on this. To finally get invited to Capital Markets, and for this Jeff v. Jeff showdown. The quick background: founder of Lambert Co, investor relations firm and public relations. 22 years ago in my basement, and found some great smart talent like these two gentlemen and many others. And then years ago we faced the challenge of reaching individual investors. This whole rise of retail has been going on for years. There are hundreds of millions of investors in individual stocks, and we wanted to reach them. So we started TiiCKER with two I's for individual investor. And so TiiCKER.com and the iOS app connects public companies to the individual investors, and perhaps never been more important than the current environment that we're in.
Absolutely. Before we get to that fun topic, and sorry, Jeff, I know you're anxious.
Tyler, I'm going to talk over you now because that's it.
What else is new? I know you're so excited to introduce the cocktail as always. So I'll let you go ahead.
It has nothing to do with the cocktail, Tyler. I have things to say. Sometimes they're important.
Sometimes they're unrelated to alcohol.
Sometimes they're not related to alcohol. So, Jeff, I'm really happy to have you on today because just for background, Jeff and I actually met more than 20 years ago. It's hard to believe how fast the time has gone by, but I was an analyst in 2000 in Portland at Red Chip Review, and Jeff brought this spunky CEO called John Stekiel from Spartan Motors in to pitch us on our dog and pony day, and fell in love with the company, and it started coverage, and Jeff and I have had a good relationship ever since then. So it's been a long time. You've added so much in terms of the company and things like TiiCKER, which I'm amazingly impressed by. The way that we're thinking about trying to connect individual investors with companies that they own and perhaps our customers of every day. I think those are great things. So anyway, that's my pitch and, in terms of my background with Jeff. Now let's get to the important stuff, which is the cocktail. So Jeff, you have suggested for us today the Manhattan.
Yes, so I chose the Manhattan both as the center of commerce. So the capital markets are centered in New York, and much of the money is no longer in Wall Street, but it's actually in Manhattan, where they run it all, and they run it through the electronic trading systems that are today. But also, I chose Manhattan because I have an office there. So cheers to the Manhattan. And I think, Jeff, you're going to talk a little bit about it. I've got some of the beautifully displayed ingredients behind me.
So basically a Manhattan, and I haven't had one before, I will confess. And no, I will correct you minorly. The capital markets really are all in Jersey City now, where I used to live when I lived in New York versus Manhattan, but that's beside the point. So Manhattan's a whiskey cocktail typically made with rye, though I am using our client MGP's Tanner's Creek bourbon today. So it's, I'm a little bit off, but that's not unusual for me. Mixed with some sweet vermouth and some dash of bitters and a couple of cherries for garnish. And here's what I've got. It's I try to do it upright. So here you go. Here. Cheers.
All right, an official cheers. Cheers, Jeffs.
I think the capital market may actually be based in Jeff Novia today, anyway.
Well, we'll see about that. I just hope that Jeff Novia doesn't encounter some explosion of sorts, but we'll see. See if it's left standing after the day. So on that note, our topic for today is one that recently came to the forefront with the trading activity in certain heavily shorted stocks. And and based on the actions of a Reddit internet forum called Wall Street Bets. So the premise of this recent trading was that meme stocks, if you will, like GameStop, AMC Theaters, and even American Airlines, have been heavily shorted by hedge funds. And based on the Redditors' collective position, the aggregate short positions were way out of sync from a normal short position, in several cases exceeding even 100% of the float of the stock. So this prompted some Redditors and a larger community of retail investors to see an opportunity and create a short squeeze by buying up the underloved shares and forcing the shorts to cover. This entire episode has prompted a lot of different commentaries and opinions, ranging from lauding the retail investors as underdogs for using the system to their advantage, to claims on the other side of market manipulation akin to a Ponzi scheme on behalf of these Redditors and retail investors. So this diversity of opinions has come even right to Lambert, as Jeff Lambert and Jeff TiiCKER have come down on, shockingly, different sides of this issue. So today's episode will be a little different than our traditional format. I'll be playing a moderator role to a degree. So let's kind of see where they've both landed on this issue, if there's any common ground. And maybe we can start off just with each Jeff giving their elevator pitch, if you will, on their perspective of the controversy. And we'll go with Lambert first.
You know, my position on this is backed up by, decades of research and market activity, which is that what happened was truly a demonstration, if you will, financial demonstration by a bunch of individual investors who got together and marched on a few stocks. And they marched with, let's pump this thing up, and lauding and encouraging one another to stay in those stocks despite there being no fundamental change in the business. Now, I certainly agree that the short sellers needed to be squeezed in this case, and it was a great opportunity to do that. But that happened in the first couple of days, and then it just got to be euphoria. And so my position is, which has happened since, is that while the news and the coverage has been all about how these Redditors have taken down Wall Street, in fact, it was many of the funds on Wall Street that made the most money, and many of those individual investors who didn't get in on the first day or the second day are the ones taking the 80%, 90% bath on them. And so I think, my simple position is this is an anomaly, and it's not going to probably happen a whole lot again. Even if they tried to do it in the silver market, and that got squashed pretty quickly. And so it wasn't a conspiracy theory by Wall Street. It was, in fact, I think, consumers making a run at a couple of stocks for almost sport. They were successful, but there won't be, I think, long-term impact or long-term change in what is ultimately the rise of the stock market, which is the fundamentals.
Jeff, I wish you were right. And what I will say is, and this goes back a long way, because when I started on Wall Street, I actually was an auditor, and we did a lot of audits of back office operations, clearing. And one of my first audits was doing proxy voting. And one of the things that was really important to me was proxy voting and how do you account for short sales? Because short sales, you're really creating shares out of nothing. And for someone who's short, you can pay a dividend. If a dividend gets paid, you could offer cash to pay a dividend, but you can't offer a vote, which is a challenge. And that's something that when you have naked short selling in particular, which is basically creating shares out of thin air, shorting them into the market, so that if I create those shares and sell them to you, Jeff, you now technically think you own the shares, but you have no rights to the voting of those shares because I have not delivered those securities. And if I borrow to deliver them, then I'm taking shares from somebody else. And when you have a situation like we had with GameStop, where you had 167% of the float was shorted, that's not natural. And that's not something that we should be advocating for on Wall Street or anywhere else, because it's really, it's a way of cheating the system. And from my perspective, I think kudos to the Reddit people for actually identifying these stocks that were heavily shorted and saying, look, you know what, this is an opportunity for a short squeeze, which, by the way, is nothing new. It's been around as long as short selling has been around. It's a very simple, strategy where you get the people to, buy back the stock, and the shorts have to cover because they're losing money, and it's a typical squeeze. That's not a big deal. The problem I have is really the differences in the way the application of the regulations and rules were created, and so when you think about it, I'm all for obeying the rules and regulations of trading in Wall Street, but I want them to be really applied equally. So when all the hedge funds were shorting these stocks, TD Ameritrade and Robinhood didn't come in and say, oh, you can't sell this anymore. We have to protect the people who own these shares. But yet, when the Reddit people were trying to buy these stocks, all of a sudden you had Robinhood and TD Ameritrade and the other brokers saying, you can't buy these anymore. And so I think it's this idea of having two sets of rules, one for the elites, one for the billionaire hedge fund managers, and one for the everyday schlub on Reddit who invests a few $100 in his Robinhood account. That it's just being applied differently. That's what I have the fundamental problem with. You're right. I don't think that they were looking at this and saying, GameStop's got a really great plan. They're going to turn it around. I don't think that was part of it either. I don't think it was fundamentals. But I have the problem with the unequal application of the rules. That's where I have the fundamental.
Well, and I appreciate that perspective, albeit wrong. But the reason why they had to stop the buying was because of the fundamentals of trading platforms like Robinhood that made it so simple to gamify investing. So there's no risk to someone jumping in quickly and jumping out or getting into the crowd, right? There's no downside. And they created such a crowd by taking away trading, and you can immediately trade without verification. That takes all the limits out, and it stops the investor protections that were put in place. And so what they were out ahead of was the backstop of the capacity of a Robinhood with the clearinghouses. Yeah, we're using a lot of arcane terms here, which is a part of the issue. Short selling is not a bazaar to sell apparel, and naked shorts is not a dirty word. So just to clarify everything. But I think the reality is that the markets were not shut down because they were trying to protect the elite or somehow not help the individuals. They had created their own mess. And there was actually a great story last week in the Wall Street Journal just talking about, investing has a PR problem. I saved it from last week, and the issue was self-created, and they've compared it to when AOL went from paid dial-up to monthly, and it crashed the internet. And so free trading created this, the consumerization of investing, which frankly I would love to get into. Let's get our differences aside. I think we both agree the rise of retail needs to get the attention of companies.
Well, and I agree with you on that. And to get even deeper into the esoteric nature of things, okay, when I was an auditor on Wall Street, I was a financial and operations principal. So I understand net capital rules. I understand short selling. I understand segregation of securities. And I understand that fundamentally, if you're in a Robinhood account, you most likely are trading in a cash account, which if you're trading in a cash account, my IRA account at TD Ameritrade is all cash. I don't buy a stock unless I have the cash in the account to cover it, which should create zero problems with clearinghouses, because if you want collateral, I just have the cash. I paid $100 for the stock. I have $100. There's no risk there for me not paying for the trade. Whereas if you're shorting 160% of the float, it seems obvious to me, and I would love to have the SEC or someone do an investigation on how much cash trading, in a cash account. My IRA account's a cash account. TD Ameritrade should not be able to loan any of my shares to anyone. There should be zero ability of them to loan my stock to a short seller or anybody else. But when you're short 160% of float, I got to think that there's some shenanigans going on there. And that's the problem. And I think that, thinking of the investor PR problem with the markets, this is part of it. Because I think we've created a situation where, like it or not, the perception among a growing number of individual investors is the game is rigged. And that's a problem. And I don't know how we fix that problem other than fixing the problem. I mean, this isn't new. Anyone who's been paying attention, I've known that the game has been rigged since 1994 when we had the peso crisis. And I got to tell you, the Treasury and the Fed did not bail out the Mexican consumer with the peso crisis. They bailed out Citibank. And that was one of the first. Then you had long-term capital management. Then you had, the chaos of 2008 with the housing market. All of these bailouts, you have, elite investors with privatized profits and socialized losses. And that is a perception that has grown over time. And it's one that is really problematic for the markets in general and for our profession, in the investor profession overall, in light of what the public perception is now. And I think what happened with GameStop has only served to exacerbate that problem.
I think what the consumers who were crying foul and that the market is rigged were simply disappointed that they didn't get in on the lottery. And when they heard the clearing firms were holding this up, I think they heard Publishers Clearing House. They think this is the lottery. It's not the lottery, right? They were crying foul after GameStop and AMC and BlackBerry had already had huge run-ups, and many of these investors had already made 10x, 100x, 1,000x their money. And so to cry foul after that, it seemed like it was simply the convenient thing to somehow blame Wall Street the day after, the week after they had quote unquote stuck it to Wall Street. So you can't have it both ways. You either stuck it to them or the game is rigged. But I think that's my disconnect.
The problem is the stuck it to them part. If they had actually, and certainly Melvin Capital, I don't even understand their strategy, in terms of going after puts versus doing a straight short. I mean, I guess, it limited their downside, but either way, I think the characterization that came out in a lot of the financial media was, some of this changes on the part of the clearinghouses was to, help, funds to really organize their positioning or something like that. And that's where, you hear those sorts of phrases in the financial media and you're thinking, okay, so I'm sorry that, I don't get that opportunity as an individual investor. And I read an article this past week that was a guy who was, having recollections of his experience during the flash crash in 2010. The flash crash was caused by algorithmic trading. We still don't even actually, quote unquote, know the cause of the flash crash, because although there have been investigations and no regulator has ever come up with any solution or cause or action to be taken as a result of it. But you had a massive crash in the markets that was instantaneous. And this guy was short the market at the time and decided to cover his short, only to find out 2 days later that his trade was canceled because, there was an exemption given for all these trades by the securities regulators to say, oh, you don't have to honor those trades because it happened during the flash crash, which was caused by your software. Do you see how this creates this perception of just insanity?
You're going a little arcane and deep, Jeffopedia. So there certainly have been flashes in the pan in these situations. But would you then have the 100 million Americans who are in 401ks and retirement accounts who benefited from the institutional investors who are gaming the market? So when they got their statement at the end of the year, they say, well, boy, I sure wish we would have given more to those individuals who are running these stocks up versus my portfolio.
That's a great point, Jeff. And I think that's certainly, that's one aspect of it. The problem is that I don't know that the vast majority of people actually benefit. And that's where you get down to, and this will, I'll sound, like some of the crazies out there that, you've seen this huge growth in income inequality and wealth inequality. And I think that's a problem. And I'm not sure, I would love it if every single person in the country was invested in their 401ks to the maximum ability and were benefiting from great market returns. I would love that. The fact of the matter is that that's not the case. And the vast majority of stock market wealth is owned by the top 10% of wealthy people. And so a lot of the bottom 90% really isn't benefiting as much from their 401k as they could be. And that's again, this all goes down for me to be, a fundamental issue of fairness and making sure that the rules are applied fairly across the board. And, we can argue about active management versus passive management and markets, and don't even get me started on the Fed intervening. That you'll get me I'll be on a tirade for an hour and a half talking about, Fed intervention and money printing and how that distorts market pricing. But I think that the perception needs to be that the rules are the rules and they're fairly applied to everybody. And I think right now you have a big perception with the market, and I'm part of the problem because I have this perception that if you are a billionaire and have a lobbyist, you're going to get treated differently than me. And I think that is a fundamental issue that we're facing as not just in our markets, but as a country right now.
Well, I think it reminds me of my favorite quote by Winston Churchill: "Fair is for children." And perhaps with that, with maybe the end of the debate back and forth of the fairness or who's to blame or things like that, maybe we can move to what maybe some of the positives that came out of this.
Well, here's the thing, and I agree with Jeff. I think one of the greatest positives to come out of this whole episode, and there's a lot of negatives, and we can debate those, but I think one of the greatest positives is people are understanding the power of the individual investor, and not so much the power to initiate short squeezes and potentially, get a gang of people on Reddit to buy a stock. But the fact is that people do own stocks and people care. People, I own stocks in, 15 companies. Maybe it's 16. I don't even know. I own a stock in the companies, but I own stock in companies because I believe in their businesses. I own stock in Wendy's because I freaking love Baconators and I love spicy chicken sandwiches. That's one of the things. And I invest in Wendy's because I like their product. I mean, I own stock in Union Pacific because I like trains. Those are things that as personal investors, as individual investors, we invest in what we understand, what we like, what we use every day. If you use Procter & Gamble products, you could buy stock in Procter & Gamble and when you buy Bounty paper towels or Puffs tissues, you can realize that, you're supporting your investment by your purchases. And I think that that's something that individual investors and companies need to really understand, that there is a wealth of potential untapped, consumer loyalty out there that until this happened, I think Wall Street was very fine with just ignoring the fact that there are individuals that own stocks.
Yeah, I think you're exactly right, Jeff. And to that point, Jeff Lambert, this is kind of exactly what TiiCKER is designed for. So how, from your perspective, can companies take advantage of some of the positive tones we're seeing out of this? How can they then apply it to their day-to-day operations to maximize the customer engagement?
Yeah, I think that there's a ton of correlation between this issue that's going on and what has always been the case, which is there's a strategic reason why the Redditors picked GameStop and BlackBerry and AMC, consumer brands that people could understand. Maybe there is a fundamental dynamic. That was the spark, right? So the run-up wasn't due to the spark, but the familiarity with the brand and how that might play into a trend was. And so that was TiiCKER, is that realization that many of these public companies have hundreds of thousands, even millions of individual investors who are consumers too. And just like Jeff buys the things that he enjoys and respects or participates in, that's how consumers have purchased stocks forever. And so if you look at Better Investing, which tracks the ownership in investment clubs, the top 25 of the most widely held in these individual investor clubs are all consumer brands. So the Google, the Alphabets, the Teslas, the McDonald's, these Nike, the brands that you know and love are the most widely held individual stocks. And yet, because of street name holding, because when you own it in your individual investor account, most times you don't elect to be visible to the company. And even if you do, they don't know anything about you other than your address. They don't know how to market to you. They don't know what your consumer behavior is, your age, your marital status, where you're from. And so these types of information is highly valued by marketers, but the marketing department doesn't even know that they have hundreds of thousands of investors. And then you take examples that my colleague here shared, like a P&G, or take a public company like Wolverine Worldwide. Well, unless you're from Michigan, you don't know Wolverine, but you might know Merrell Footwear, you might know Sebago, you might own an Airstream, which is part of a public company named Thor. You might wear Converse. They're not public. Oh, yes, they are. They're part of Nike. And so these are the education, but also really syncing up with that brand loyalty. And again, just the top 5 online brokerages: E-Trade, Ameritrade, Fidelity, Schwab, and Robinhood, which, by the way, Robinhood has the least amount of assets of all 5 of those, even though they have the most awareness. But those 5 combine 10.6 trillion with a T, dollars in assets. 10.6 trillion. That's a bigger demographic than any other marketplace. And so that's a huge opportunity. And that's what TiiCKER is ultimately doing, is connecting public companies with their investors and converting consumers to shareholders.
Yeah, and on the other side of that, then there may be, while there is positive notions with this trend, there may be some anxiety around their shares becoming a meme stock. So how do those companies think about that? How do they react to sudden changes in trading patterns? I mean, from both a retail and an institutional messaging standpoint.
I can jump on that real quick. I think I actually did another interview, a less important publication than this, but I did an interview about what are the steps for the internal communications or investor relations. And the first thing is to talk to your inside audiences, right? Your employees, your frontline workers at a GameStop store that has no idea what this all means. Is this a good thing, a bad thing? The AMC theaters, your inside audience was first. Secondly, institutional owners, they could have run this up and sold into the increase, and at the end of the day, you're worse off than you were when you started. And so I think that's another audience. And then, we actually tweeted at and suggested to several of these organizations, why not capitalize on all these new investors? They're all consumers. They're in GameStop. They're now aware of what's going on. Why not offer them a perk, reward, the reward and perks of ownership? They would use it. You can convert millions of people who bought your stock into consumers. And I think that would still be a great opportunity for them to leverage this awareness into something positive.
One thing I would add to that, Jeff, is I think it's also important and incumbent upon investor relations officers and management teams at companies to keep an eye on their short positions, and look at, for all of our clients over the past few weeks, we've looked at very closely at, what are your short positions? What is it as a percentage of float? And thankfully for most of our clients, it's relatively small. But if we saw a rise in that, it goes back to the old adage with investor relations is you got to know the bear story. You have to know what are the short sellers saying, and is that true? And if it's, in the case of a GameStop, I know that I'm not very familiar with the company itself and what they've been telling investors. I really haven't paid close attention to the company, but I know that fundamentally, I have, my computer guy is a gaming geek, and he stopped buying games on discs in like 2007. So, this is not something that hasn't been kind of brewing for a long time. and if they're taking actions, if they're adjusting their strategy to address maybe the decline of brick and mortar video game stores, what are they doing, and how are they communicating that to investors?
I would just ask, as there's still obviously a lot of ambiguity, some outstanding questions. Maybe if each of you could just leave with a closing thought on each of your perspectives. I know we can agree, there is a PR problem within the marketplace, but maybe if you could come up with a campaign or a slogan or just a final thought from your perspective on these issues.
Well, I'll start with just, this Manhattan is great. And Mr. TiiCKER, I hope that your first Manhattan was all it cracked up to be. I don't see you taking a lot of sips, but hopefully you...
It's because he hasn't stopped talking.
You do enjoy it.
To be fair, I've been drinking while you've been talking, and look, I'm almost gone. See, look at how much I've drank.
Nice. Well done.
You see what you cause? You caused me to drink more.
I think if you, depending on who you consider to be the bull or the bear here, I think, one thing is that you should always buy TiiCKER JEFF. That's always a strong buy. And then I would just say that the rise of retail has been well cataloged. I think what's interesting is it's been around below the surface for decades. And so suddenly it's being discovered. And the rise of retail has risen, and we look forward to benefiting from it. And frankly, companies waking up and saying, this is a huge opportunity. No longer do we ignore the individual investors because they're somehow difficult or annoying or inefficient. They are here to stay, and they're important.
Yeah, I think that encapsulates this well, and I've seen that Jeff has finished his drink, so I don't really want to understand what he might say as a closing argument here.
Well, of course, I'm going to have something to say, and regardless of, I still have a little left, so I haven't.
His show, he gets the last word.
But
which is also a good cocktail.
It is, yeah, it's a great cocktail. I'm anxious to eat the cherries. But that's an aside for now. But I think fundamentally, investors need to understand the fundamentals. I think it's easy to get caught up in kind of a hysteria or a mania or things like that. But the reality is, I think that individual investors, we shouldn't shortchange them. We should, make sure that the laws and the regulations are applied fairly across the board. And I think that we need to really, quite honestly, give individual investors a little more respect. I think that a lot of them, people are just saying, oh, this is the dumb money coming in here. And I don't really think individual investors, being that I'm one of them, I don't think they're the dumb money. I think that they actually, kudos to these guys. I didn't see a single hedge fund in the country saying, you know what, we should try and do a short squeeze on all these stocks that have 160% of float shorted. That's a genius maneuver. And it was done by a bunch of guys on Reddit. That to me says that this isn't really the dumb money as it's portrayed a lot of times. There's a lot of smart money in individual investors. And I think that the Wall Street needs to respect them. And I think issuers need to respect them and build relationships with them for the long term.
Well, thank you, Jeff and Jeff, for the discussion today. And to steal a slogan from this movement, we're hopeful to take not only this podcast, but TiiCKER to the moon. So please, if you found any value, please share this on your channels and tune in with us next time. Thanks again, and cheers.
Thanks for having me.
Cheers, everyone.
Cheers.